Hello, Business 201. This illustration shows the solution to problem 6.3a, the effects of omitting adjusting journal entries from the financial statements. This is a follow-on exercise to an exercise that we did in a previous day that showed the effects of adding adjusting journal entries. We are just doing the opposite. What is the omission? According to the exercise, you have a company that had net income for the month of April of $120,000. It had net assets of $750,000, liabilities of $300,000, and it had total owner's equity of $450,000, which in this exercise we have broken into $200,000 of contributed capital and $250,000 of earned capital. We also have 4 journal entries, and in this case we are assuming that these journal entries have been omitted. For each of them, we want to show the effects on the financial statements if we inappropriately omitted those journal entries. The first journal entry was the omission of the entry to increase supplies expense and to decrease the asset supplies. So if we had omitted this debit to supplies expense, this expense account would have been understated by $2,750, and the omission of this credit would have caused the assets to be overstated by $2,750. With just these 2 items accounted for, you notice that the total debits, $752,750, do not equal the total credits of the balance sheet, $750,000, so that's a signal that there must be some secondary effects. Anytime we affect a revenue or an expense account, we also must remember that we affect income. So if we had shown an income that was too small, the effect on income would be to overstate it by the same amount, $2,750. And since income is part of the earned capital that is reported on the balance sheet, if we overstate income, we also would overstate earned capital. And in this case, once we complete the secondary effects, you can see that the assets equal the sum of the liabilities and owner's equity, and we're complete with this transaction. In transaction 2, if we omit the journal entry to increase receivables and increase fees revenue, what we would have done is to have assets, accounts receivable is an asset, understated by $23,700, and we would have understated revenue, or $23,700. If we understate our revenue, we would have understated the income, and income is part of earned capital, so also we would have understated earned capital. Balance sheet balances, so we are completed with transaction 2. For transaction 3, we omitted the journal entry debiting depreciation expense and crediting accumulated depreciation. The omission of a debit to an expense account means that we would have understated the expense account by $1,800. And since accumulated depreciation tracks the credits to the asset account equipment, omitting a credit essentially from an asset account means that we would have overstated the asset account by $1,800. The balance sheet doesn't balance, so we must account for the secondary effects. If we understate an expense, we did not take enough away from revenue, we would have overstated income, and consequently we would have overstated earned capital. Entering the secondary effects, you can see that the balance sheet now balances, and we're done with transaction C. Finally, let's examine the omission of a debit to wage expense and a credit to wages payable. The omission of a debit to an expense means that we would not have shown expenses large enough so we would have understated the expense, and the omission of a credit to accounts payable is a liability, and not having enough credits means that we would have understated the liability. These two items don't account for the entire change, so we must account for the secondary effects. If we understate an expense, we would have overstated a revenue, and if we overstate revenue, we would have, and income, we would have overstated earned capital. So, with the entry of the secondary effects, we now see that the balance sheet balances, and we are now complete with the analysis. So, the effect of not recording these journal entries would be that the original income adjusted would have been $120,000. Had we not made those entries, income would have been less at $102,250. So income would have been understated by some $17,250 as a result of omitting those journal entries. There you have it. Give this example a try. Enjoy.